everyone. It's Tabitha from the 1111 Hour and Help Me Build My Business Australia. Tonight we have a really exciting one. It's all about buying a home when you're self-employed and how it can be a bit different to buying a home when you're employed by another business. So as we wait for people to jump online, I just wanted to say that we've got a really exciting thing happening over at 1111hour.com.au, and it's our monthly mingle. So at the moment, we've got quite a few people that have signed up for the monthly mingle. It's a completely free networking opportunity where you get to meet people that are in business just like you, and we're just going to catch up once a month and get to know each other and see how we can help each other. So that's exciting. As you sign on, I'd love to hear where you're from. So if you can pop in the comments where you're listening from, that would be really awesome. We'd love to see. I'm in Geelong. Delan?
I'm in Melbourne.
Melbourne, yeah. So we're welcoming Delan to the Tuesday Night Live family tonight. Delan is an awesome mortgage broker based in Melbourne, and it's really wonderful to have you on. You know that Delan is someone that I know previously and has helped me with my own home loan, and so I know that she's wonderful, and I know that you're going to get a lot of value out of tonight. So it's lovely to see you all jumping on. I can see Chris. Welcome, Chris, and I'm excited to see where this conversation takes us, Delan.
Thank you, Tabitha. Hi, everyone. Good to be here, and thank you for the opportunity.
That's okay. No, thank you. Thank you very much. So as we go into the presentation tonight, you are more than welcome. Everyone is more than welcome to ask questions. Delan is here and happy to answer your questions. If you've got a tricky question for Delan, she may ask you to send her an email or give her a call, which is absolutely something I would recommend. So let's get into it, Delan. So What are we going to be covering tonight?
We're covering the requirements for self-employed mortgage, like residential loans, majorly, and then we're going to talk about the policies with different lenders and the choices we can have. Because we are self-employed, like our loan structure usually will look quite different. And then I think it's more to know what's required, then we can be prepared for in the process of buying, we'll know when to provide what document. So then planning ahead is always a great start.
Yes, that's right. Planning ahead, I would recommend that for sure. Okay, so a full doc loan. So what we need to know, yeah?
So a full doc loan, when we talk about like full doc, it means that we're going to assess everything in terms of being a self-employed like sole trader or company. But sole traders and companies will be dealt with very differently with the institutes and lenders. So like when we talk about lenders, we'll have major banks, and also we have like special lenders, and they also have like full doc. Usually full doc is with most of the banks, where they're going to assess all your financials and all your they need to identify your identity, and they need to make sure that your income is going to be sustainable once you purchase the property. So then like in terms of sole trader and company, ideally we want you to be in operation for like minimum 18 months for most of banks. But then we do have special lenders. Sometimes they would take you for under a year, and ideally you want to be at least operating at least for 6 months. But then there are special circumstances where you could be a sole trader for 3 years, and then you become a company owner. Then your company ABN probably will be only operating, ACN will only be operating for 6 months, but before that you were a sole trader. So then in terms of all these scenarios, we will look at your income tax, which is the most common one for a sole trader. and then we look at the notice of assessment. And then we're going to look into your debts. So we want to see if you have enough to cover all the mortgage repayments. So in terms of company or partnership or trust, the common thing we're going to look at is your profit and loss statement and your balance sheet. So when we talk about like profit and loss statement, like we want to assess the profit of the company. So often we say, as a business owner, we often be assessed on the revenue. So we like, how much did you make this year? And then we talk about the revenue, the turnover. But then at the end of the day, we look at the profit that we make. We could be making a loss when we have a very good sales turnover for the year. But then the bank will look at your profit. They want to see if you're making enough profit from the business to be able to sustain your mortgage repayment. Yeah.
If you're paying yourself a wage and you've got a company and your profit's low, but your wage is, enough, I suppose, to service that loan, is that enough? Or say the business is even taking breaking even and you're taking an income, that's totally okay? Is that how it can work? Yeah.
Yes, that's a way we pay ourselves. Like I think two ways we're paying ourselves as a small company owner or a small business owner is you either pay yourself a wage or like towards the end of the financial year you'll take out a lump sum for yourself. So both ways we can recognize the earnings, but like sometimes if you're paying yourself as a in terms of wages, you probably will get a quicker assessment because in a way you are like a PAYG, you're paying yourself. So then, so you probably will have a quicker assessment in terms of not looking at your financials as closely. But then if you're a company that putting in your 2 years of financials, then you sometimes as you're starting, as we know, maybe 6 months of starting a business, sometimes your income is always low. And then you gradually pick up in a second year. But then banks will usually ask for the 2 years of financial. So minimum is 18 months. Yeah. Sure. But then, it's common they look at 2 years. There are few banks that will look at only the better of the 2 years, or they can look at the last 12 months. And that's where we can utilize the policy, and we can go to those banks who only assess you for the year or for the 12 months that has a higher income and use that as your income.
Sure.
So that usually will benefit our small business owners in a bit. And 1 year financials, this is a very, very interesting area. It's sometimes if you're PAYG, you probably just need 6 months of pay slips. But when you're a company owner, we need you to have 18 months of ABN for full doc. If you don't, we can always find a different lending solution where, but the problem with that is there's a higher interest and a higher cost. Yeah.
Sure.
So, we have a question here. How do lenders view irregular incomes, and what steps can I take to improve my chances of getting a home loan? So when we look at irregular incomes, we want to also look at the stability of it. So if over the 2 financial years you have a similar amount of irregular income, then we will look at the average of that. So it's okay for the incomes not to come in a regular manner. But if over the 2 years period you get similar amount of income, then we're more likely to assess you as the full income as the average. Yeah. Okay. And for us to improve that chance of getting a home loan is to make sure that we do our financials. So sometimes we could leave the financials to last minute, or sometimes we will take out we'll do a drawing and then take out a large sum of money out of the business revenue, or and also if you're going to purchase a property very soon, then you also want to minimize the purchase of non-current assets within within that financial year as well. Because if you're purchasing a house, then probably we've got to, save up more for purchasing the non-current assets later on. Yeah.
Okay.
So yeah, and also like debt, business debt is another thing we look at. So basically, bank is assessing your income minus your liabilities, like your constant liabilities you got to pay back. So if you have a large amount of business debt, that will reduce your overall profit in the long run, and then that will make you it will be more challenging for you to meet up all the repayment requirements for mortgage. Yeah.
Yeah.
And
Yeah, that makes sense.
yeah, so yeah, I think that also comes to how would you like to purchase the property. So if the property is under your name, or would you purchase the property under the company's name? That's a different scenario as well. So
Sure.
yeah, because like if you're purchasing as a person, like, and you're going individual and you have a property, like as a like owner occupied property, we have a lot of first home buyers grant. We also have like a lot of benefits for it as well. So we have no land tax and all that. But then when you're purchasing as an investment from a company, then it's different nature. Yeah.
Okay. Ah, that's
Yeah.
interesting. I didn't know. I didn't know that. Wow.
Yeah. So
Okay.
yeah, you can purchase a property like, with trust with company, then that's different. That we assess it differently, but then the benefit of that is it's going to, the company is the owner of the property.
Okay. And are there any other benefits to that?
I think the benefit of that is that it's a separate legal entity. So then it's not going to be prone to your personal liabilities and all different,
Oh,
changes in your life. But
that
then
makes
like, that's a lot of people have a trust in a company, like, have a trust because you have a company, you build a company trust and you can purchase a property with it.
okay.
Yeah.
Okay. Oh, interesting. Okay. Okay.
So I think Cherry asked about what is the cons of purchasing as a company and trust. I think the major disadvantage of that is you don't have as much tax benefits on it, because if you have an owner occupied and then you have like no land tax on an owner occupied property, and then it's easier to manage as a person. But then you just got to put that onto the company financial statements, which will make the whole financial statement like reporting much more complicated for the year as well. So if you have like rental incomes, if you have rental expenses, you have to prepare a separate section in terms of the financial profit and loss summary. It just makes the whole process more complicated. But then you
Yeah.
can always go to your accountants and then just provide all the details of your investment property.
Okay. Okay. Awesome. Okay. All right. So could you give us a little crash course, Delan, in what LVR and DTI, and I'm seeing these things on the screen, and some people might not be as familiar with them.
Yeah.
What that means.
Yeah, so LVR is in terms of how much equity you do have in your property. So so say if you have this is LVR is loan to value ratio. So if we say 80% of LVR, basically means that you are borrowing 80% of the value of that property. So it's called loan to value ratio. So then it's like say a property is 100,000, and then you're going to borrow 80,000 for it. Yeah. So it's
Oh,
like 80% of a loan. So the most common ratio is 80%, meaning that we've got to have 20% deposit before we purchase a property. This
sure.
is without, yeah. So if we are first time buyer of a property, then you generally speaking with the first home buyers, like, guarantee, or like, the support that the the government is having, then we can have the 15% guaranteed by the government. So then a first home buyer they only need to have 5% deposit to purchase a property. But whereas, like, if you have purchased your first property and you sold it and you're going to go and purchase it again, it's ideally you want to have 20% deposit for the interest rate to be minimum.
Okay, that makes
Yeah.
sense. Yeah, that
Yeah,
makes sense.
you can still purchase with like 5%, but then your interest rate will be a bit higher than usual. So
Yeah.
the common interest rate now is that for owner occupier you will have 6.5%. But then if it's like, if you only have 5% deposit, you're prone to paying interest rate probably over 7%, and then also like you're more likely to pay lender's mortgage insurance.
Sure. Lender's mortgage insurance. Give us a crash
Yeah.
course in that one.
So lender's mortgage insurance is typically what we need to pay. The insurance we pay when we have less than 20% of deposit on a property. So, but then you can always add it to the loan amount you have, and you don't have to. It's not that once you have lender's mortgage insurance, you have to pay for it. Like, say if you generate enough equity in a property, or say if you purchase a property for like 500,000, yeah, but then like say you only have 5%, which is 25,000 within, like, as a deposit. Then like the bank will probably charge another 20,000 as lender's mortgage insurance. So when you actually work out the cost, you're going to pay 20,000, but then you can have it on top of the loan. So instead of like paying that 20%, the 20,000 out pocket, you can just like add it onto the loan amount you have. And then say in 2 years the property has gone up in value, then now say the property is now worth 600,000, then even though you only have 25,000 in it as a deposit, but then the property is worth more now. So it's like you have that extra 100,000 as equity. So then if now you refinance it, then you wouldn't need to have the mortgage insurance to it. Like, so then you can just get out
That's
of paying the
interesting.
lender's
Yeah.
mortgage
I've
insurance.
never thought about it like that before, but that's true. That makes a point. That's a good point.
Yeah,
Yeah.
so I think when we purchase, it is also important to look at the growth in the area.
Yeah,
So then
definitely.
then if the area is growing, and then like probably then your property will go up in equity quicker.
Mm.
Yeah,
Oh, that
and
makes a lot of sense. Yeah.
and then when we talk about like debt to income ratio, so like debt to income ratio is more like how much debt you have and to how much income you have. So we usually saying that income should be like should be able to cover your debts. So then we want that, it's like basically saying income should be 6 times more in terms of like comparing to your debts. Yeah.
Okay. Okay. That makes sense. Okay,
So
good.
yeah, when I say like it should be under 6, it's just saying like your debts shouldn't, like your income should be able to cover your debts.
Yeah.
So
Yeah.
say like generally speaking, if we have like an earning of 100,000, and then like it's likely we can borrow 6 times more, but no more than that. Yeah.
Yes, you mentioned that to me one day, and because I asked that question, didn't I? I was like, oh, how does it work? How do you actually assess based off somebody's income? Yeah, okay, and that also is affected by the interest rate and all that too, isn't it?
Yes. So
Yes.
when time is good, you can have like 6.5,
Mm,
6, like just a rough calculation. So say if you think about how much I can borrow, you can be like,
mm,
oh, it's maybe 6 times of my total earning. But then when you think about that, if you wanting to buy investment, you also want to take in consideration of the rental income. So
Oh,
you're going to get all the incomes and times that by 6. Like 5 is safer at the moment, but yeah,
mhm.
some like if
Ah,
we push to the max is 6.
yeah. Okay. Oh, that makes
Yeah.
heaps of sense. Okay, that's cool. Yeah, I love that rough idea. I know that obviously debts and things like that come into play and the interest rate, but it's interesting. It's always nice to have a really basic calculation so you can sort of go, okay, that's what I'm aiming for with my income. You've
Yeah.
got an idea when you know what kind of property that you're wanting to end up with.
Yeah,
Yeah.
but with that, it's also like have to think about that's a total debt. So that
Mhm.
means you also need to think about your credit cards and your car loans. And
Yeah.
but then yeah, it's tricky when we include credit cards and car loans because the interest rates are generally higher, and then the
Mhm.
repayment period is generally shorter. So then, like it will have strength. It will restrain how much you can borrow. So
Yeah.
like things you can do is like close your credit cards or like pay off your car loans. So then like that will make a huge difference in terms of like borrowing capacity.
Yeah.
So if you
Yeah.
can get rid of all the debts before you want to purchase a property, then it just
Mm.
increase the chance or increase the amount of money you can borrow.
Yeah, yeah, exactly. So maybe sometimes it's best to concentrate on what you've got going on. You have to have a really good handle on your money, don't you? Like you've got to know what your budget, what you've got in your budget, what you've got to work with, what your outgoings are. And if you can try and get rid of some of that debt or reduce it as much as possible before you go and buy it, it's always going to work in your favor.
Yeah, and I think like when you purchase a property, when we're new to the market, it's always good to like get used to like having few $1,000s set aside every month just for
Mm.
paying the mortgage. And it takes a while for us to get into the habit of doing so.
Yeah.
And then then also in terms of like being small business owners, we also need to look at the variations between the 2 years of reporting.
Mm.
So if there's a 20% differences between the previous profit and this year's profit, we always need to give them the reasonable reason. And then like when we really really want to purchase something and then we say we don't have the 18 months ABN, or then like we we're struggling with our financial statements, like say if we're behind, or like it's a partnership, you find it hard to get the documents just because you want to purchase a house, then we also have the low doc option. So then, in terms of this, you sometimes you can have like less than 2 years, and then but generally we want 2 years of financials. We still have like product that's requiring like documents for less than 2 years, but then the LVR sometimes is having that low doc usually means your LVR has to be 80%. So it means that you need to have 20% deposit. Whereas if you go full doc, you're going with a bank. It's possible for you to have like 10% if you're happy
Mm.
to go with a higher interest rate. So if
Okay.
you really, yeah, if you're really, really confident with the place and you really think it's going to be a area that's growing, or you're purchasing a block of land, you really want to like build on it, and then by all means, it is a short-term option, yeah. And once you have enough equity, you can always move into a full doc. Or once you have like the full 2 years of financial, you can always
Yeah.
change products. But it's
Yeah.
just like we got to know where we're going. We need to know the business is sustainable. We don't want to be like in terms of like now we have enough income, but next year we don't have enough income. Then it will be hard for us to go back to a full doc
Mm.
application.
This might
And
be
you,
a silly question, but it's just popped
yeah,
into my head. Does it matter what kind of business that you run in how they assess it? So say you're running a business that they sort of think, like the bank may think is not viable long term? I can't even think of an example, but I wonder if there are instances like that.
There will be, but not usual. Not usual. So it's very, very unlikely. As far as you can establish that, you have the long term income, like long term revenue. But then, like sometimes there are places that they don't support you in buying.
Okay.
Well, yeah, there
Okay.
are
All right.
properties. Yeah.
Sure. Yeah.
So yeah, so sometimes banks will really take a step back if it's like it's a hotel, motel, or like it's or sometimes it's a residential that property but being used for like as a restaurant or things like that. Then banks will usually take a step back of like they're not wanting to lend to you for it, even though it's a fully residential property.
Okay.
And yeah,
Okay.
also they look at the area, if it's like, prone to flood or like, it's
Mm,
prone to other natural disasters. Sometimes they take a step back for,
sure.
funding you because they rather you will pay for the full amount for it than the bank taking the risk for it.
So like if it was a block of land that was, I don't know, in the middle of nowhere and it's not like, or even if it's a block of land that doesn't have the permission to build on it yet, when you can buy blocks of land that isn't designed for that or isn't zoned for that, they wouldn't lend you that.
Yeah.
Yeah,
Yeah, the
got it.
funding will
Okay,
be an issue. Yeah,
got
because
it.
they want to see the income for it. And if there's no income for it, they're happy for you to purchase it, with cash or like
Yeah.
apartments that's less nice, smaller than 50-meter squares.
Mm-hmm.
Usually it's hard to get finances for it. But there are banks who do it, just not a lot. So then this is like, why, we think brokers are very useful in this space where like we can give you an overview of different lenders, different products, and then like you can
Mm.
make that choice rather than that's if you walk to a bank it's usually this is the option, that's what you do, and then you have to go to 3-4 different banks to compare the rates, look at the
Mm.
products. Whereas if you come to us, it's just like we can guide you through the process from day one till settlement. So I,
Yes.
I think that's a difference. That's why in
That is,
America,
yeah.
like most purchases are done through brokers,
Mm-hmm.
and where in Australia we're going towards that pattern. But it's because like real estate market is so different. It's always changing. So it
Yeah.
just makes it very a space that sometimes we're really scared to get into. But it's
Yeah.
like especially for small business owners, it's just like it seems like we don't have a lot of options. But in fact, if we know how to prepare, what to prepare, and the whole process, it just makes the whole thing much easier for us.
Yeah, yeah. And that, look, you have run through some really great options for small business owners. We've got a question here. Here's one. Are there any tax deductions or benefits I can take advantage of as a self-employed first home buyer?
Yeah, I think self-employed first home buyer, especially for first home buyer, we have the scheme where you only need 5% deposit, and then like in Victoria, you probably don't get the first home buyers grant that we sometimes have for like if you building a new place. But then if you are just buying a new place, then you will get stamp duty waived for purchasing under property under 750,000. So if you're over 750,000, you only need to pay for the stamp duty for whatever that's over. So which that's a very very beneficial policy, because if you're going to pay for stamp duty, you always need to out pocket 20-30,000 just on top
Yeah.
of your purchase. But then if you have the stamp duty waiver, which means it will save you that as a first home buyer, and also you only need 5% deposit, which means as far as your income can service your purchase, then you
Mm.
don't need that much of a deposit, because usually And to purchase a property, the first thing we think about is the deposit, and we always think we need that 20%, but in fact we don't. So we
Okay.
just need we just need the 5%. And sometimes if you're willing to, like, share your house with the government can also have that share buying option where they will pay for 30%. But then the downfall of that is, once you sell the property, you got to share the profit with the government.
I remember that being an option when we bought our home, actually, but we didn't do that.
Yeah.
But yeah, it's well, it's it's helpful to some people who don't quite meet the requirements for the amount that they need. Isn't that correct? Is that right? So
Yes,
say,
yes. So
yeah,
if you don't have enough, if you don't have borrowing capacity, and then also you, like, if you don't have enough borrowing capacity and you also don't have enough deposit, then we have the home buyer fund shared equity scheme. So where,
mhm,
like, you just need 5%, but the government will contribute 25% of the purchase price. Yeah.
yeah,
But
yeah,
then you just, the only downfall of that is that when you selling it, the government has to share the profit with you. Yeah.
yeah, yeah,
But then,
yeah,
this means you're
yeah.
not,
It's
like, bind
understandable.
by the first home buyers.
Yeah. Well, it's understandable why somebody might choose that option because it is hard, and it's good that are those things available. Deb Fribbins says, is there any way someone can get finance to build or buy a house to downsize before their house is sold if the dollars make sense?
Yes, yes, yes. So with this, we have the bridging. So which is a bridging finance. Not a lot of lender does it, but when they have the bridging finance, means that you can have a period of time where you're going to pay for the interest for your current property and the property you're buying or your property you're building.
Hmm.
And I think, like, what's a bit tricky about this is the construction, because construction and bridging, both of them are not something that a lot of banks do. But then, like, we've got a few banks do them. So we can take advantage of the policy where we're going to do the bridging as far as you have the equity for the two properties. So say if you have one property to be like 500,000, and say the other property you want to downsize to is, like, say 400,000, which
Hmm.
means you at some stage you pay interest for both properties, which is like 900,000 in total value. But then that just means that you've got to have the deposit, which is the equity in your
Hmm.
current property, for around 180,000. So you need to have 20% of both properties.
Okay.
So in that case, you can apply for bridging, and then you can pay for the interest for both properties before you sell the current one that you're living in. And also, like, for small business owners, we also have the opportunity to, like, say, purchase equipment, or, like, you can get cash out options to purchase other businesses, or you want to have, more cash flow. Then, like, say if you have a house already and you want to, like, say, get some funding, usually you can get it through business funding, and then you can also get it through, like, say, refinancing. You can add more cash onto what you have now, and then you get cash out and you can use the funding to purchase equipment. Or you can also go to special lenders to just fund for the equipment and fund for the cash flow. But then usually the thing about this is the interest rates is a bit higher than a residential property. You can also use, lending or institutes as, like, tax debt consolidation. So say if you have, like, tax debts and you want to pay for it. So, like, there are a lot of things we can do as, like, in terms of funding or in terms of purchasing property investments. And it's just like, we got to have a clear goal to know what we want to do. And I think
Mhm.
ideally, as a small business owner, I think it will be good for us to establish a business and then purchase our properties, and then we think about equipment
Mhm.
and cash outs, because if we have any debts on the equipment or cash flow, it will have impact on our borrowing capacity. So
That makes sense. Yeah.
yeah.
Do you think it's good to have a mortgage broker that you work with? You find somebody that you really gel with and stick with, and share your goals with, so then they can potentially give you some advice on how to reach those goals, those finance goals. Like, I know you and I have chats occasionally, hey,
Yes,
these are
yes.
some goals that I have, and you'll give me, a bit of an idea of where I need to hit. And do you think that that's important to have? Or do you think people
Definitely.
should shop around? Is it, what would you, I know you're a mortgage broker, it's in your best interest for me to go with you, obviously,
Mm.
but like, is it better to create a relationship with somebody over time and share with you their goals? Because I think the more information I give you, the better you can help me. Am I right?
Yes, yes. And
Yeah.
I think that's my primary reason to come into the industry. Because it never popped into my mind to become a mortgage broker until I purchased my place. And I
Mhm.
realized how important they are. And I find that sometimes a good one really change your life, but a bad one will really make your life difficult as well. So
Mm.
I did have an experience where I trust my mortgage broker, and I trust that he has put in an application when he did not. And then before settlement, before my house was settled, I bought a block of land back then. And
Yes.
like a month before, like my broker just told me that it wasn't submitted and everything wasn't there. So then it is extremely difficult to get a bank to deal with you within a month, because
Yes.
usually ideally you want 2 months in advance, where you can take maybe 2 weeks to submit the application, a week for them to look at it, and then probably another 2 weeks at least before you settle,
Mm.
before your settlement. So then I really struggled, and then I feel like I was I studied accounting in my major in as a bachelor and then masters, and I thought that this is not that hard. So then I
Yeah.
start learning and did all my qualifications, and I think the most important thing for me is to help people like me. I probably don't have the most amount of money, but then I really want to have a property, because
Yeah.
I think
Yeah.
it's a lot of time it's that knowledge. It's like the missing piece of knowledge.
Yeah, that's a great question. What makes a good broker versus a bad broker?
I think it's the relationship and the vision. So it's for us. I think our job should be more like a advisor, a financial advisor in terms of a long run, because you
Mm.
don't want a broker that you use once and never talk to ever again. You want someone that you can talk to, who is happy to answer your calls, happy to talk to you every now and then about what your next move is, and then share your vision and give you a bit of advice on what to do, because sometimes when we purchase our home we get very comfortable and we will never think about investments. But then I think as business people, we in fact capable of doing so. So then I think it's more to share the vision, if you want investment property, what's the value, and also giving you the choice. So not only say, oh, this is what you should do. I think it's more like the relationship between us is like you present me with the information, and then I will have the due diligence to tell you, oh, you
Mm.
got these three options, and I think they are they will benefit you in different ways, and they will give
Yes.
you the choice. Yeah, I think that makes a huge difference for me. I think I think it's just a mutual understanding relationship we're building, and it should be a long-term relationship.
Yeah, that's what I like. I mean, I sometimes email you, Delan, and I'll be like, okay, here's some food for thought. What do you think of this? And you'll always come back at me with something, with a clear view of how to accomplish that, or if that's possible. And that I like. If you can find somebody like Delan, and my relationship, if you can find somebody like that who can go back and forth with you, even when you're not about to buy another home, and you're not going to be, obviously not every time I've contacted Delan I've bought a house or anything like that. But sometimes I might say, hey, Delan, what do you think of this? Is this possible? And she'll give me the rundown of what I need to do to achieve that. I like that about Delan, and I like that about, that's what I think a good mortgage broker is. Somebody that is approachable at any time, to walk you through your options.
Yeah, because I think our job is very special, very unique, because you guys trust us so much that you basically will probably know more about your financials than anyone else.
That's
Maybe
right.
it's just your accountants and me. And then I think that due diligence of being trustworthy and protecting your best interest and giving you advices. Like, say if you're going to sell your house now, if you have that thought of it, and I'll be like, oh, what's our best option? Do you think bridging will be a better option than rather than sell it off and then start looking for somewhere else? So then I think it's just having that option, knowing you're making an educated choice rather than, oh, this is what I feel like doing now, and that's what I should do. So I think just that discussion it's valuable for us, and I enjoy that, and I think it's just it's good to be there to support people.
Yeah, and maintain relationships, because that's what
Yes.
it's about. I mean, why would I come back to you, Delan, if I didn't have that? You didn't make me feel welcome,
Yeah,
So,
for
yeah,
sure.
I think that's a really good point. Forms of verification. So when you apply for a loan, you need some of these things. Yeah.
Yes. So this is what we got to think about. So say if we can always do a better job when we are more prepared. And same thing applies here when we're going to apply for a mortgage. Usually we want to have prepared information. We don't want to rock up and be like, oh, I don't have my statements ready. I cannot assess my accountants now, because we always have other options. At least you can provide maybe some statements, accounting letter that would do, or you have the best, or you have the accounting statements. So we got to have something to process the information. And also we also need your accountants to be on the same page, because if they're not aware that you're going to purchase a property, sometimes they reluctant to talk to people, just rock up randomly to them, or call them randomly and be like, oh, is this true, or can you show me the statements? But then the thing about broker and the accountant is sometimes they will be able to explain the figures in a financial statement better. So then, because there are things we will process within the statements, say if you have depreciations, we're going to add back, and then we're also going to analyze the whole variation within your income statement over the 2 years. And if the accountants can let us know what is the reason for the variation, then it is easier for us to be accountable to the bank, because we are like the medium between the client and the bank. So the bank will come to us to ask for information, and where we will come to you and we can present your information to the bank. And the bank likes that, because sometimes we know the ratios, the calculations and everything, so we know what is the figure to present.
Mm-hmm.
So that's why that's why there is us in between the clients and the bank. One, we can provide you with a more broader overview of different banks, different lenders, and your choices. And to them, it's we can make sure all the clients come to them with roughly prepared statements and everything, rather than coming from stage one and go through all the way to settlement, which will be a long process if they have a million clients. Yeah.
Yeah, no, it makes sense. So to streamline things for yourself, it's good to have
Yes.
everything in order. Yeah.
Yeah.
No, that makes a lot of sense. Fees and charges. So we talked about lenders' mortgage insurance before, but yeah, let's run through that.
Yeah, so when we purchase a place, we also need to think about like not only the deposit and also the value of the property. We also need to think about uh, lender's mortgage insurance, or we think about application, settlement fees, legal fees, valuation fees. So these are all the fees that you probably will come encounter when you purchase a property. So things like application fees and settlement fees, that it's usually going to be taken out of your loan. So say sometimes you borrow 200,000 or 500,000, then you'll never see that figure of 500,000 sitting in your bank. You'll always have a bit of like extra money that you need to pay, and that's why usually if you're purchasing a property rather than refinancing, you need to have a legal person in between. So usually for property purpose, we have a conveyancer. So then they will add up all the property value, the mortgage and everything, and they will tell you what's the extra amount to be paid. And like usually you pay the deposit to the real estate, but then you need to have funds to complete on settlement day.
Sure.
So just be prepared. Don't just drain yourself to a stage that you can't afford the extra 1,000 here, or extra 250 there. So just be, have a bit of buffer. But even though that, when we calculate, we'll give you a bit of buffer as well. So it won't just be so specific that you drain the last dollar out. But then we need to be aware of it. So it's not like, why do I have this? Why do I have that?
Yeah, we don't want surprises. No one wants surprises at the last minute. They don't.
Especially when we're paying, And the stamp duty, I think stamp duty is usually the large chunk.
Yeah.
We got a question here. So how will my requirements as self-employed differ from a standard home loan? So I think a standard home loan is majorly looking through your pay slips. But whereas self-employed, we will need to submit our financials. So as self-employed, we need to submit our best statements and also our financials, like profit and loss summary and income statements, like balance sheet to the lenders. And then we also need to have that usual 18 months ABN, which is a killer a lot of times. It's like sometimes we're doing so well, like in the first year, but then we're trying to buy a property, but then we could not because of the regulation and the restriction of we have to have 18 months of the ABN, because they want you to stay in business rather than going out of business without notifying anyone. But then when you have pay slips, if you have occupation and you are in a job for more than 6 months, then they usually think you can find another job within the industry in 6 months. Whereas as a self-employed, sometimes you feel like the policy is so strict on us. So then I think it is always good for us to be prepared. So that if we know we're going to purchase a property, we always go and check, if my ABN has been running for 18 months, or if this is a time I feel like my business is expanding, but then rather than jump into my company from sole trader straight away, but then I also need to think about, can I purchase my property before I change my sole trader business into a company business? Because if I change to company now, then I need to verify my 3 years prior of incomes as a sole trader. So it just makes the paperwork much more daunting for us. So it's so that's why it is important for us to know what's required. How can I make it easier?
Yeah, and I also think it's good to go to someone like you, Delan, before you're ready. Before you're ready. So even if you've been in business 12 months and you're like, goodness, I've done really well, I think this is good and everything's going well. It's a good idea to have the chat with someone like Delan and say, hey, what does my next year need to look like? to make it count, and let someone know that you let the mortgage broker know what your goal is. Say you're looking at an area, it's going to cost you $500,000. You'll then know what deposit you need. You'll know what you need your business to do. I think that certainly helps if you can create a relationship with somebody that can actually let you know what you need to do, as opposed to just winging it and hoping for the best and, applying. Yeah.
Exactly. We also got to be careful when we apply because every time we apply for something, the bank will like inquire our credit file. So then like we also need to be, aware of our credit ratings.
Yes. So what if I am not sure about what my credit rating is, and what do you recommend people to do in the lead up? Is it good to check your credit rating and know what it is?
We can check it for you, and I think that's also a good thing because that when we check it, it's a soft touch. So then we can just like check how well you are, and then like instead of like submitting your applications to different lenders, not knowing how your credit rating is, and then also it gives you a peace of mind knowing that you meet the general criteria. So usually we can do the credit checking for you in advance, and we can also let you know like what to do and what's the things that we don't want to do. So things like defaulting your credit cards or like fall behind in payments. Then like you also want to clear up the credit card debts, and then also because when they run the credit check, they can see everything. If you have defaults, they just want to make sure that you pay off all your defaults. And then once you pay off your defaults, those companies will take you off the rating, take you off the list, and then will make your credit rating be better. Because if your credit rating is under a certain number, then like banks usually won't assess the file. Then that will create a new problem.
Yeah. Interesting.
Yeah.
The first home loan deposit scheme, we sort of touched on it. What have we got here?
So I think it's just like for us to know how can we be qualified for first home loan deposit scheme. So this is for like first home buyers where you are a citizen, or you can be a couple or de facto, but you will not have purchased a property. So neither of you have purchased a property in Australia. And then usually we expect you to pay like principal and interest as repayments, because for investment property sometimes you can have like interest only for 5 years. So because as a tax benefit you can claim back the interest paid on the investment property, but then you also have to report your investment property incomes. But then with first home loan deposit scheme, then we try to make sure that more people can purchase their first home. So then here we also have the genuine saving, which is 5%. So the 5% genuine saving means like you can be like paying rent for the last year, which is the same amount of the 5% of the property you're purchasing. You can use that to show that, or you can also have like earnings for the last 3 months where you have the savings. So it just means that your deposit shouldn't just rock up in your bank account like a week before you purchase any properties. So I just want to make sure that you have the ability to save up.
Okay, so if for example you get an inheritance, so do you have to let that sit in your bank account for a certain amount of time, or how could you use that as a deposit?
You want to I would recommend you have that deposit sit in your bank for at least 3 months.
Yes.
Because, because otherwise, you haven't demonstrated the ability of keeping the deposit in your account.
Sure.
Yeah.
And perhaps adding to it, I guess, too.
Yeah. So we also have price cap. So in Victoria, it's 750,000. But then it changes over the years, and in different states it could be different. Okay. And then we also want to make sure we're helping like people that not the ones with 200,000 K a year. So we also have the earning cap. So basically with this, not all banks do it. Some banks do it, but then like a lot of major banks do it. So where like you put in the 5% and then they will guarantee the 15% for you. So then you only need the 5%, but you will use the interest rate of an normal homeowner. So which is not a lot. Yeah, so you're not on a higher interest bracket. And then you also have the stamp duty benefit.
Okay.
Yeah. So it's a very, very good start as a first homeowner. Yeah.
And you must earn under the thresholds there.
Yeah.
Under 125K for a single and 200K for a couple. Interesting. Okay.
Yeah.
Okay. Cool. Okay. And what if we wanted to get an investment property?
Yeah, so I think this is also for you, like something to think about whether you want to purchase a property, like when you're not living in it. So say, you can buy a first house as an investment property, but which means you wouldn't get the government benefit. But then say if you really want to live in inner city, but then like you feel the growth in apartments is really slow, then you could continue renting in the apartment, but purchase a house, in the outer suburb. So we call this rent vestar. So the benefits of this is that, obviously if you feel the growth is more in the house than the apartment, then feel free to do that. And then sometimes it guarantees you having the lifestyle that you want, but then also on the side you can have the investment property. And then also there are other scenarios where you have owner occupied property and you want to purchase an investment property. Yep. And this is where we can utilize the growth in the property, where we can leverage it as the equity across the two properties. So like the example, we have one property to be 500,000 and the second property to be 400,000. If your property is worth 500,000, but then if you have 200,000 as equity in it, which means it's 20% across the 900,000 of property combined. So you can use that to leverage the purchasing of the second property. Yeah. You could do it through like collateral. So you collect two properties together, use the two properties as security, and then you just borrow the rest of the amounts. But then the risk of that is if you fall behind on payments on one, both properties will be liable to be taken back by the bank.
Okay.
Right. Yeah, it's good to keep them separate for that purpose if you ever think that's going to happen. If you keep it separately, you can always refinance the first property, get the cash out from the first property, and use it as the deposit for the second one.
Okay.
Yeah.
Right. Yeah, no, that makes a lot of sense.
So that's a very common thing to do.
Yeah. Okay. So it's important that we consider certain things when we're an investor, yeah?
Yes. So we need to think about the ongoing cost, because we can't always think, the rental income is going to cover the outgoing expense. We also always need to think about, you need to pay for the repayments. Would you consider interest only for 5 years, or would you pay for interest and the principal? The benefit of that will make the long term shorter. But if you have interest only for 5 years, means that you need to pay off the whole thing in 35 years rather than 30, because you had the 5 years of interest only. And then we also need to, that's just like, we have to be aware of all the hidden cost of having investment property.
Yeah, it's very important to be well informed, because, there are a lot of hidden costs, with an investment.
Yes, but the benefit of that is that, you'll never go wrong with the real estate. In the market, a house, a land is always going to appreciate in value in terms of the land, but the building on top of it might, depreciate over the years. So then,
Sure.
like, choices of what you're purchasing for the investment is another thing to consider. So, the
Mm,
value, the area, the growth, and
sure.
the cost. Yeah. And I think the steps is just like, we need to think about, you do the research, you can prepare the deposit, and then you have property search. So, two common things you have is like having an auction or having a private sales. So if you have an auction, it will be good for us to work out, the borrowing capacity and have pre-approval before you go into an auction. And
Sure.
whereas, yeah, if you have a private sales, you can just put the offer through, and then like, if they take the offer, we just need to inform the bank and make sure we get approval from the bank, and then we can prepare for a settlement.
Sure.
And
Sure.
yeah, just we got to think about different structure of the investment we're going to think about.
Yeah. Yeah. I think it goes back to having those conversations with your broker and being really clear on what your goals are, isn't it?
Yeah. So then, and we can also sit down and compare properties. You can,
Yeah,
you
definitely.
can, oh, this is what I'm interested in, and that's what I'm interested in. So then,
Yeah.
from my perspective, I can tell you, how much you need for each one.
Yeah, true, true. And maybe sort of the steps to get to each one as
Yeah,
along the way. Yeah. So yeah, the process is pretty simple, I guess. I guess there's lots within each step, but it sounds simple.
yeah. So I think the most like involved like step for you as a client is the in within the application. So we'll need
Mm,
all the documents. I'll be bothering you all the time for this and that. Yeah, but
yeah.
like usually if we've done it once, probably next time around I wouldn't be like coming to ask you for driver license and like, notice of assessments constantly. But then we will have conditional. So once we put the application through, usually within a week we'll hear back from the bank if they're quick, and then they usually go to conditional approval, and they will ask for different things like a few different extra documents or information that they need. We can
What's
just
a common
provide
thing
it.
that they might ask you for, Delan? What's one of the common things that they might ask?
Common
As
things like, yeah, sometimes say if you have provided your financial statements as um as a business owner, sometimes they could ask you for a accountant's letter, and
sure.
like just showing you don't have extra debts. Or sometimes they want you to, if you provide 1 year, so say you have the better of the 2 years,
Mm,
and this bank is only can take only 1 year. Sometimes they will ask you for explanation. So that's when that you can explain why there was this variation, and we'll put it into the broken notes, and then we send
sure.
it to the bank. So then, like sometimes I really like the process where they listen to us, like it's like it's a communication. They'll be like, oh, also this credit card was there, and would you be able to do something about it? And then that's when we're going to come back and be like, oh, it's conditionally approved, given you can, like, say, close down your credit cards. And once you've done that, I'll send them the documentation showing it's been closed, and then
Mm,
they'll go to unconditional.
yeah.
Yeah.
Okay. Okay. And then it's just about getting to settlement, really, isn't it? The
Yes,
exciting.
it will be the exciting time.
We've had a heap of great questions throughout, so I'm going to skip that slide. And here are Delan's details. So if you'd like to get in touch with Delan and ask any further information, like questions, or if you'd like to provide a bit of information about yourself and your unique circumstances, please get in touch with Delan. She's wonderful. Just a simple email or a phone call. There you go. And readyfinance.com.au is her website address. Thank you, everyone, for coming on tonight. Thank you, Delan.
Thank you. Thank you so
It's,
much, everyone. And I really love the opportunity.
yeah, it's been great. The hour flies.
I
And
know.
thank you for everyone that stuck around. Remember to jump on the 1111hour.com.au website and sign up for the monthly mingle. It's free, and it's just a great time to catch up with fellow business owners and support one another in business. Roy says a great reference video for assisting home or investing buying decisions. Yes, I agree. It's been awesome. I know there's so much detail that we could have packed into this, but it's, it's only an hour, isn't it, Delan? So maybe
I
we'll have you
know, it's
back.
too short. Yeah.
We can do some more. We can do another one later in the year if you like, and go into
Sure.
some more detail on certain parts to this. Please send your requests through to us if you're interested with 1111 Hour. If you'd like to hear more from Delan on the podcast, and yeah, as you can see, details on the screen. Amazing amount of info in this live. Awesome. Thanks heaps. Oh my goodness, we're getting some lovely comments. It's beautiful. Thank you very much.
Thanks,
Um,
Delan.
Thanks, Delan. Thanks, everyone. Thanks, Cherry, in the comments. And thanks, everyone that joined us tonight.
Thank you, everyone.